Welcome back to the Deep Dive. Today, we are putting on our investor caps and diving straight into one of the most resilient stories in modern retail. We're talking about the off-price giant, the TJX companies.
That's right. TJ Maxx, Marshalls, Home Goods, all of them.
Exactly. And the timing here is, well, it's perfect. They just released their Q3 fiscal year 2026 results from November 19th, and they weren't just good.
No, not at all. They were an object lesson in how to win in this environment.
So what's our mission for you today?
Okay, so we're not just going to read you the numbers. We want to analyze how they did this. How a company didn't just meet expectations, but, completely crush their own internal plan. Specifically, how did that whole treasure hunt model really monetize what's happening in the market right now?
All right, so let's set the baseline, the key numbers.
The key numbers,
Yeah.
okay? Q3 consolidated comparable sales growth hit 5%. Their pre-tax profit margin was 12.7%, and diluted EPS, $1.28. And the company's own words were that these results were well above the company's plan. This isn't just a little beat. This is a major acceleration.
Okay, let's unpack that acceleration. If we look at the raw financial snapshot for Q3, you start seeing why management is so confident. Net sales for the quarter came in at $15.1 billion.
Which is a huge 7% increase year over year. Very strong.
And that sales volume pushed their net income to $1.4 billion. But the real headline for investors is always that bottom line number, right? The EPS.
Always. And it hit $1.28.
A 12% jump from the $1.14 last year.
Right. And a 12% growth in EPS. You just don't see that every day in retail, especially not right now.
So what does that double-digit EPS growth really mean for someone watching this space? It's not just, raising prices with inflation.
No, absolutely not. When you see 12% EPS growth on 7% sales growth, it signals two really crucial things. First, they're definitely taking market share from competitors who can't offer that same value. And second, maybe more importantly, they are showing massive operating leverage. Their costs just aren't rising as fast as their sales are.
Which lets that profitability flow right down to
the shareholders. It's just textbook operational efficiency.
And this momentum, it's not just a one-off for the quarter, right?
Yeah.
If we zoom out to the year-to-date numbers.
Consistency is the key word. Exactly. Year-to-date, net sales are at $42.6 billion, and that's holding that 7% growth rate.
And the comps.
Consolidated comps are up 4% for the 9 months, and diluted EPS for the period is $3.30. That's a solid 9% jump over last year. So yes, this is a sustainable high-growth model.
And it's exactly why the CEO, Ernie Herrmann, he was so quick to connect it all back to their main advantage.
The treasure hunt.
He said it was a testament to our value proposition and treasure hunt shopping experience.
Yeah.
They know exactly why they're winning.
Of course. Because when shoppers are being really careful with their money, that treasure hunt dynamic, it creates urgency. You see it, you have to buy it now.
Because it won't be there tomorrow.
It won't be there tomorrow. And that feeling, that translates directly into traffic and sales.
Okay, let's drill down into the divisions then. Where did that 5% comp sales growth actually come from? What does it tell us about shoppers? Let's start with the U.S. consumer. Marmaxx, which is the big one, TJ Maxx, Marshalls, Sierra, it posted net sales over $9 billion.
And their comparable sales growth, it hit 6%.
6%.
Yeah, 6% comp for Marmaxx is huge, especially when you remember that last year, in the same quarter, it was only plus 2%. That's a serious acceleration in traffic. It means the core value proposition is resonating more now than it was a year ago.
And it wasn't just clothes and accessories. Home goods, which includes HomeSense, also saw its growth speed up.
It did. It went to 5% comp sales, up from 3% last year.
Net sales of over $2.5 billion.
And that 5% at Home Goods is really interesting. The whole home furnishings market has cooled way down since the pandemic.
Right.
But TJX is proving that if you package it as this unique discounted discovery, shoppers will absolutely still show up. They're definitely pulling sales away from the traditional specialty stores.
Okay, so let's look beyond the U.S. TJX Canada actually had the strongest growth of any division.
An incredible 8%.
8%. And last year,
they were only at plus 2%. So that acceleration in Canada it really stands out. It shows the whole off-price playbook is working flawlessly across the border.
But by contrast, TJX International, so that's Europe and Australia, they reported 3% comp sales. Still positive, but it's a slowdown from last year's 7%.
Yeah, and that divergence is worth noting. It suggests that, while the overall model's strong, there might be some market-specific challenges. Maybe in Europe, acting as a bit of a headwind.
Some of the North American divisions just aren't facing as much.
Exactly.
And quickly on global factors.
Yeah.
Currency. That can always skew things when you're selling all over the world.
It can, but for Q3, it was basically a wash. It had a neutral impact on sales growth, so that 7% gain is all organic. They did get a tiny 1-cent boost to EPS from it, though.
Okay, so that profitability, it brings us right to their margins. That 12.7% pre-tax profit margin is huge. This tells us it wasn't just about selling more stuff. Something was going on internally.
Oh, absolutely. This is where we stop looking at the customer and start looking at the supply chain.
And the secret sauce is in the gross profit margin.
It is. It increased by a full percentage point to 32.6%. And that gain came from two things: a higher merchandise margin and getting expense leverage on all that sales volume.
Okay, let's pull that thread on merchandise margin. The report says it was driven by lower freight costs. How big of a deal is that specific factor for a company like TJX?
It is. It's transformative for them. Think about their model. They are constantly buying opportunistic inventory from all over the world. So freight costs, the price of getting a container from Asia to a DC, that's a massive variable cost for them. So when global supply chains get back to normal and those container costs just plummet, TJX benefits way more than a traditional retailer. Every single dollar they save on freight goes directly to the merchandise margin. It's a straight line to profitability.
So an industry-wide trend-lower shipping costs becomes a massive strategic advantage for their specific model.
That's it.
Okay, that makes perfect sense. Now, you also mentioned expense leverage. Can you unpack that for us?
Of course, expense leverage is just when your sales grow much faster than your fixed costs. So think about store rent, utilities. Those costs don't really change much whether you sell $15 billion or $16 billion. When your net sales jump 7%, you're spreading those fixed costs over a much bigger pool of revenue. So as a percentage of sales, your cost base actually shrinks, and that makes the overall profit margin expand.
Incredible. Now, it is worth noting that even with these tailwinds, their SG&A, their administrative costs, did go up.
They did, up 0.6 percentage points to 20.1% of sales. But the reason why is the key. It wasn't inefficiency.
No, it was actually due to deliberate investment driven by their success.
Exactly. The main drivers were incremental store wages, which you need to keep good staff, and critically higher incentive compensation accruals.
Meaning they're paying out more in bonuses.
They're paying out more in bonuses because the team just knocked it out of the park. And they also made a contribution to the TJX Foundation. So this is a retailer investing in its people because it's so profitable, not struggling with costs. It's a very healthy sign.
Let's connect this all back to the treasure hunt. That model needs a constant, massive churn of inventory. So what did their inventory picture look like?
It's pretty dynamic. Total inventories hit $9.4 billion. That's up from $8.4 billion last year.
Wow.
And on a per-store basis, inventories are up a full 8%.
Now, for any other retailer, an 8% inventory jump sounds like a huge red flag, like product that isn't selling. But for TJX, they frame this as a positive.
That's the key distinction. The CEO said this increase reflects terrific buying opportunities and outstanding availability in the marketplace.
So their gain is another retailer's pain.
Precisely. If full-price stores are stuck with too much stuff, or vendors have excess supply, TJX's buyers swoop in, buy it cheap, and then use that abundance to fuel the treasure hunt.
So that 8% increase is basically inventory they bought below market value, setting them up perfectly for the holidays.
Exactly. They have filled the pipeline with high-quality, deeply discounted product. They are ready for the holiday shoppers.
All right, moving on to capital allocation.
Yeah.
How do they manage all the cash this model generates? What does it tell us?
Well, first, they're just swimming in cash. They generated $1.5 billion of operating cash flow in Q3 alone. They ended the quarter with $4.6 billion in cash.
That gives them a lot of flexibility.
Tremendous flexibility, and they are very aggressive about rewarding shareholders with it.
How aggressive?
They returned $1.1 billion to shareholders in Q3. That was about $594 million in stock buybacks and $472 million in dividends.
And they're not stopping. They now expect to repurchase about $2.5 billion of stock for the full fiscal year.
Which is management putting its money where its mouth is. They're essentially saying they think their own stock is undervalued. It's a huge sign of internal confidence.
And that confidence shows up in their raised guidance for the full year.
It has to. The Q3 performance was so strong, they had to lift their outlook.
So their new guidance for full-year comps is now up 4%. And the EPS outlook has been raised pretty significantly to between $4.63 and $4.66.
And in percentage terms, that range is a projected 9% increase over last year. For a retailer this big to sustain 9% EPS growth is well, it's remarkable.
Now, despite all this optimism, their Q4 guidance is still pretty careful. They're planning for comps to be up 2% to 3%.
And that's just a sign of good management. They know Q3 was exceptional, partly because of those temporary supply chain advantages. They're setting a realistic bar for a very competitive holiday season.
Not getting ahead of themselves.
Not at all.
And finally, a quick note on physical growth. They are still expanding that footprint. They added 57 stores this quarter.
Yep, bringing them to over 5,100 stores globally.
Yeah.
It's controlled, steady expansion.
And they also publish their 2025 Global Corporate Responsibility Report.
Right.
So they're managing that ESG narrative at the same time.
It shows they can walk and chew gum at the same time. Financial success and corporate responsibility.
So let's summarize the really critical knowledge nuggets here. The TJX model is firing on all cylinders because it's capitalizing on two big market conditions right now.
Right. One, the external factor of lower freight costs is flowing straight to their gross margin. And two, they're feasting on widespread vendor overstocking, which lets their buyers get great merchandise at deep discounts.
Which keeps the treasure hunt exciting.
Exactly. They're turning temporary supply chain dislocations into sustainable profit, even while they invest in their people.
TJX's success really is a masterclass in strategic execution. They are turning all this macro-level economic weirdness into micro-level pricing power. It's that balance between value and the thrill of discovery. But this brings us to a final provocative thought. The report is clear. Per-store inventory is up 8%. A strategic move to absorb all these terrific buying opportunities. But the whole success of the treasure hunt relies on a feeling of scarcity, right? This idea that if you don't buy it now, it's gone.
Sure, that urgency is key.
So the question for you to consider is this. How long can TJX maintain that essential scarcity mindset, that thrill, while also holding so much available inventory? At what point does this flood of available merchandise risk diluting the very thing that makes the bargain feel so special? That tension between strategic volume and experiential scarcity, that's the ultimate long-term challenge.